Hey everyone. Before we get into today's show, I want to give a quick shout out to our sponsors, Coinbase Prime and Ledger. Love these companies, genuinely proud to call them sponsors of the show. You're going to be hearing all about them later from me, but now, on with the program.
The biggest threat to the United States is not terrorism, it's not weapons of mass destruction, it's not climate change, it's our debt, and it's specifically we're borrowing money from China to build weapons to face down China.
We're seeing how fragile the world economy is. We're seeing how weaponized everybody is having to become to protect their own domestic affairs. And key to all of this is the dollar.
All right, everyone. Welcome back to another very special episode of On the Margin. I am very lucky to be joined today by Mr. Grant Williams and Luke Gromen. How are you doing, gentlemen?
Good to see both of you, gents.
Likewise, good to be here. Thanks for having us on, Michael.
Okay, guys, I want to get right into it here. So I really want to start on this topic of China. Grant, there was a memorandum, maybe we could start, there was a memo that came out from the U.S. back in May of last year. You wrote something called the Long Telegram to respond. It was a pretty fantastic document. Your take on it was great. Maybe we can start there. What was the memorandum that came out back in May? Why did you feel compelled to write about it?
Well, it was really the Chinese effectively saying we're at war with the U.S. I mean, it was pretty bold and pretty cut and dried. And I think what we've seen through all the Trump trade negotiations and into the Biden administration is kind of an escalating, ratcheting war of rhetoric originally. But the Chinese have been very, very clear about this. They have come out and said we're at war with the U.S. And I think what we've seen in the last 2 years through the pandemic is just how fragile the Western economy is and the Western financial system is. And so clearly when we see recent moves like the port in Harbin being shut and the damage that's done to supply chains in the West, you can talk about it in many different ways, but there's a lot of people saying that this is China kind of just prodding and poking and testing the West to see how those supply chains hold up, and obviously they're lacking dramatically. So I think what we have here is kind of a war of sorts between the two countries, but they're being fought on different levels and with different intensities. Now, where they converge ultimately is yet to be decided. Hopefully, the cooler heads and the more kind of relaxed attitude of the West will prevail, but I certainly wouldn't bet on that, because I think the kind of the tensions in China domestically are ratcheting up as well. Particularly if we get onto the subject of inflation later on, that's always been China's Achilles heel, food price inflation. So the world has kind of created a very fragile ecosystem in logistic terms through outsourcing and globalization. We've created a very fragile system by burdening it with a ridiculous amount of debt. And now we have the two main protagonists in that system at odds with each other. So you don't have to be a rocket scientist to figure out that none of that is good for the immediate future. And we have to kind of figure out how it's going to play out and where the stresses are and where the opportunities might be.
Yeah. I think, Luke, you called it something, there was an interview that the two of you did about a year ago with Preston Pish, and you called it kind of this great competition, right? So when you look at this budding conflict between these two empires, what are we talking about here? Is this an extension of trade war, kind of an economic competition? Is this a Cold War that we're entering in, something like the U.S. and the Russia did back in the 60s? Or is this a full-scale, kinetic conflict? Like, how do you see the coming conflict, or maybe the stages of it?
It's interesting. There was a document put out called the Longer Telegram by an anonymous former Western government official. And one of the things they said in that document was that the Chinese in 2002 identified a 20-year window of opportunity that they thought they had while the United States in particular was distracted by what was going on in the Middle East and the adventure we decided to go on for 20 years over there. And as it turns out, they were exactly right. And so while we were distracted in the Middle East, if you recall, right before we went in there in December of 2001, China ascended to the WTO as I think, most favored nation. The United States immediately lost a significant amount of manufacturing jobs over the next 3 to 5 years. And I think at that point in time, the dogma, the economic dogma and the zeitgeist of the era was free trade is good, and we don't want these manufacturing jobs. We don't need them, and ultimately, it's better for us to have the cheaper consumer goods. And so this is a positive, and China is this emerging market, non-threatening nation, and by trading with them, we will bring them along and liberalize them, and sort of all of these Western ideals we imprinted on how we thought the situation would go. And fast forward 20 years, and what we now find is, as Rush Doshi in the book The Long Game pointed out, the United States has never had in its history an adversary or group of adversaries who totaled 60% or more of U.S. GDP. So World War I, the Axis powers never, the Axis powers never amounted to 60% of U.S. GDP. World War II, the Axis powers economies never amounted to 60% of U.S. GDP. USSR in the height of the Cold War, same thing. China reached that level in 2014. And so I think sometime in the 2013-2014 timeframe, maybe even earlier, arguably, when you had people like Chairman of the Joint Chiefs of Staff, Admiral Michael Mullen in 2011, saying the biggest threat to the United States is not terrorism, it's not weapons of mass destruction, it's not climate change, it's our debt, and it's specifically we're borrowing money from China to build weapons to face down China, and this isn't sustainable. I think the Chinese, going back 20 years, saw a window of opportunity where I think they have what I would call, at the policy level, a much greater appreciation of history than Americans do. And I think they did not look back on what they call their century of humiliation very fondly, and saw a chance to bring back a formerly great power, a window of opportunity, and went about doing so very methodically. I think for the first part of that, America, it wasn't even a conflict. We were by far the superior power. We saw an opportunity to liberalize them, etc. I think in the second half of that period, you started to see U.S. military and intelligence officials begin to recognize that, hey, maybe there's a threat here. But still, civilian policymakers, corporate America, the banking system wanted to hear nothing of it. And I think post-COVID, you now have this situation where there's almost kind of a civil conflict within the United States around this. In other words, I think overall there's a recognition that there is a tension and a competition. And to Grant's point, it's multi-level. So certain areas it's friendly, certain areas it's very, very adversarial. But even within the United States, I would say it's still half and half, where there's still a lot of people in America getting rich because of China that don't want us to do anything about China. And, you need look no further than the reaction of LeBron James around Hong Kong, for example. He was very vocal on Black Lives Matter. You said anything about Hong Kong, he slapped that down very fast. And that's the type of dynamic that I think has been kicked off. And I would say the numbers on the side saying, hey, we need to change we need to redefine the relationship with China. The numbers with sort of that house within the United States grew meaningfully post-COVID. So it's multi-level and it's dynamic and moving. But that's how I would define it.
In terms of your framework for looking at the relationship today, there's like a whole spectrum, right? So we're entering some sort of competition with China, right? There's one way of looking at it is like, this is the Thucydides trap, right? There's an empire kind of on the waning side of things and one on the rise, and conflict is going to arise there. Luke, you were at our event in Bretton Woods. There was some more serious rhetoric than that, right? And some folks tend to actually single out the Chinese Communist Party as being a kind of a malignant actor, actually, on the global stage. And actually, U.S. companies that are funding or interacting with the Chinese market, you almost have an ethical or moral obligation not to do that. So when you kind of look at the intermingling interest in between the U.S. and China, where do both of you shake out? Do you think that the U.S. companies shouldn't be interacting in the Chinese market? Should we not be trying to get funding from China out of some moral or nation-wide interest? Or where do you kind of shake out on that whole issue?
Xi is halfway through a purge. It started off as a corruption and bribery crackdown. There's several high-profile businessmen gone to jail. There's regulators have been executed. Social media stars have been vanished. There are things going on in China that suggest that he is absolutely strengthening his grip on the country ahead of the next party Congress. Meanwhile, in the U.S., obviously, the problems there are wholly different. You've got an economy that is, quote unquote, booming, if you want to listen to people. But I think any of us that are immersed in that world know that that's absolutely not the way things are. You've got a population wholly dependent upon stimulus checks, and you've got a country whose finances don't allow it to continue that kind of largesse to the entire population without serious ramifications. Now, do they have the printing press and the ability to print that money? Yes, but at some point that's going to come home to roost. So each of these two countries has domestic problems which require careful management. And anytime you get any situation like this, it never hurts to have a common enemy, and particularly if it's an outside, overseas enemy that, who look different to us and think differently to us and, salute a different flag to us. So unfortunately, we have two leaders grappling with problematic domestic situations, and we have two countries who make for perfect outlets for any kind of stress you want to kind of generate at home and push out into the world. So it's a very fragile time. I mean, in America, there's been a lot of talk about the ethical approach to taking capital from China, from allowing companies to raise money on the New York Stock Exchange. When you look at what's happened to companies in China in the other direction, there are two different games being played, and capitalism is many things. But as Luke quite rightly pointed out, there are a lot of people getting very, very rich off of doing business in and with the Chinese, and they are not, unfortunately, about to give that kind of position up without a fight. I mean, you only have to look at what's happened with Kaplan and Rosengren at the Fed. You've got billionaires front running the market to make a few $1,000,000. So capitalism is maybe alive, but it's not well, and it hasn't been for some time now because of the way that the kind of this old line about capitalism without bankruptcy is like Catholicism without hell, and it's so true. And because we've kind of got rid of the idea of bankruptcies, everything's on life support, it's emboldened people. And the things like the two Fed governors trading their PAs while they're setting monetary policy is the kind of story that I'm sure people hope gets buried very, very fast, because if you think about that as a signal of how deep the rot is in Western financial circles, financial markets, it's a very, very savage indictment on how this system and where the system has gone to. You look at the impunity with which certain charismatic CEOs make statements that are totally outlandish and total nonsense with no form of punishment. They can commit securities fraud with abandon and not be punished for it apart from a slap on the wrist. There is a huge moral decline here in financial markets in the West, and that goes absolutely against any idea that you will persuade people to do the moral thing and refuse to do business with the Chinese, or refuse to accept funding with the Chinese, or refuse to make money by listing the Chinese companies in the U.S. This kind of stuff has to come from the top. And if you compare that to China, where they executed one of the regulators for certain misdeeds, you see the difference between the two. And when we talk about capitalism with Chinese characteristics, that used to go in one direction, and one could almost say now it goes in the other direction. So I think the capitalist system is very fragile right now, simply because it's refused. It's stopped being a true capitalist system, with the downsides inherent in it for some time now.
Yeah, it's interesting because I think in China, if you talk about the wrong things, you get literally disappeared, right? As we've seen. In America, if you talk about the wrong things, you get career disappeared. You get financially disappeared.
But now, look, you do disappear technically, right? But you get cancelled for this kind of stuff.
Right.
And
right.
It's different, but it's the same.
Yeah, it's a matter of degrees. I would argue you're not dead, but you're broke and you are discredited, or you're an extremist, or when you talk about the ongoing issues in Xinjiang. yes, those things are awful. And I don't know how to equate that with what we just saw transpire in the Middle East over the last 20 years, where we went to war on a lie, what was absolutely a lie, and cost at least as many lives as are said to have been that have been lost or threatened or imprisoned over there. So the challenge in all this is to make, like you said, Grant, is after you've spent the last 20 years eroding away at your own moral base, then to turn around and ask your populace to follow some sort of moral imperative to fight some group of others it's a big ask. And then while you continue, especially when you're continuing to undermine your own moral imperative in ways like we just talked about with Kaplan and Rosengren, et cetera, I think the thought process out here in flyover country is people are too busy trying to make ends meet to worry about we need to fight China. We out here we were saying, hey, this sending all our jobs to China is a bad idea. People were saying that 15, 20 years ago, and I said this at Bretton Woods, is I think part of the reason the Beltway in particular, but the coasts and Wall Street have all of a sudden, in the last 3 to 5 years said, oh my gosh, China's bad, China's bad, China's bad. Where were these people 15 years ago? Because that's what people were saying in the Midwest 15 years ago in the Rust Belt. And we were effectively told, shut up and, go take your $12 an hour job with no benefits and, take a subprime mortgage as a consolation prize. And people, I think what's happening, why we're seeing part of what's driving this policy maker, sort of, Beltway and coastal fear/response to China, redefinition of China as an adversary, is I think these people are finally realizing China might actually win. I think 15 years ago, when they were winning in the Rust Belt, and that's I said at Bretton Woods, I can tell you China can win because I've watched it happen with my own eyes. In the Rust Belt, they already won. They won 10 years ago. And I think it's this recognition, this awakening, and maybe it coincided with that moment where China surpassed the 60% of U.S. GDP, unlike any other adversary in history, where these people said, oh my gosh, China's an adversary now. This was all fun and games while, they were getting hurt. But now they're going to take my job. Now they're going to take capital markets from me. Now they're going to set trade policy with the Arabs, not me. This is unacceptable. So I think there's a very big dose of cynicism, I guess, about sort of the rallying cry of some sort of moral imperative about China now, 15 to 20 years after. Look, they knocked down one of our spy planes in April of 2001 and held our guys hostage and stripped the plane clean by all accounts. It's the old frog and scorpion story, right? Where frog swims across and the scorpion asks for a ride, and frog says, well, why should I give you a ride? Because, if you sting me, then I'll die. And the scorpion said, well, I would never do that. We'll both drown. And frog says, well, I guess that's right. And they get about halfway across the stream, and the scorpion stings a frog, and as they're both drowning, he goes, why'd you do that? He goes, I'm a scorpion. That's what I do. So, there's sort of a level of cynicism, maybe even schadenfreude, when it comes to talk of, from policymakers about this sort of moral imperative now.
And there's a great interview with a guy named Sir James Goldsmith that happened back in the 90s, and they're talking about globalization. Mm-hmm. And he's making this case that, 20, 30 years later, he was just dead right. And the response and the mocking and the condescension and the moral arguments that were used against him, everyone should just go and watch this interview. I think it's really emblematic. So,
Michael, there's a very similar speech that Margaret Thatcher made, her last speech to the House of Commons, before she left office. Same thing, talking about the European project. And if you listen to that speech, again, you'll see she called just about everything that happened with the European project, but again, the derision and the ridicule by the establishment that wanted to be part of Europe. This is one of the oldest tales in the world, right? The people who can sit down and think these things through. And the sad thing is, what Goldsmith said. It's not wildly improbable. It's, if you sit down and think about what he says, it makes perfect rational sense that is one of the ways this could go. But as was what Thatcher said, But unfortunately, even back then, we live in this world where there is a narrative, there is a mainstream narrative, and it's important to get that narrative backed by the public conscious.
To what extent is this competition between the U.S. and China a battling of two ideologies that don't necessarily go together? Like my grandpa, he was a Marine, he fought in World War II. He used to tell me about like the domino effect, right? Which we used to be very concerned about communism kind of spreading from country to country. And then now it's like, oh, maybe that isn't necessarily the case. Maybe it didn't work like that. But it seems like that's starting to kind of come back, and there's this coalition forming, right, between kind of Russia and China, and they're ideologically united, and the U.S. over here. To what extent are we watching just a battle of ideologies play out? I mean, how important is that to understanding the conflict?
I think there are deep, probably uncrossable ideological differences between, say, the U.S. and China. But I think at a very primal level, some of what we're watching is China knows that under this current currency system, they will have a currency crisis and their economy will collapse and their people will starve if they have to keep buying oil only in dollars. When you can find any number of interviews that Kyle Bass has offered over the last 2 to 3 years. He's been on the newswaves highlighting, look, China needs more and more oil to keep growing their economy. They have to keep growing their economy or else they have social unrest. They need more and more oil to grow their economy. That oil is priced in dollars. They only have so many dollars in reserves. Once they run out of dollar reserves, then they either have to stop buying as much oil, in which case their economy slows, they have social unrest, they can't pay their debt, their economy collapses, or they devalue their currency, they have higher hyperinflation of oil and food, which also is one of their key risks. And so he's been on the media waves for the last 3 to 5 years, effectively talking about weaponizing oil through the dollar, weaponizing the dollar through oil, however you want to phrase it. And that's the problem. And so China needs to get away from, they're never going to be able to produce enough oil. That's not an option. So they've gone around the world buying up oil supplies, et cetera. They're never going to be able to produce enough oil for what they need, so they need to import it. But if they need to import it, then to avoid this inevitable currency crisis and economic collapse, they have to be able to buy oil in their own currency, a currency they can print. And that's why, ultimately, for China, it's a matter of national security to get away from this, from the dollar monopoly on oil. And the Russians know the same thing. And so it's almost like this, it's the enemy of my enemy is my friend, because obviously the Russians and the Chinese have not had throughout history, they've not tended to be natural allies. But ultimately, you sort of have to face your challenges in order. And number one challenge for both of them is the dollar system, as it's structured. There's a great meme out there. Of course Iran is threatening us. Look how close they put their country to all our military bases. Right, and they show all of the military bases surrounding Iran, surrounding China, surrounding Russia, and so if you look at it from both sides, I really think what we're watching is sort of this competition for resources, competition for the structure of the system, who gets a say for the system. There are different constituencies within each country regarding who likes the system, who doesn't like the system. To my earlier point about there's a lot of people in America getting rich with doing business with China, and others being hurt by it. So you have internal struggles, concurrent with this. But I don't know that it's a domino theory as much as it is just realpolitik around resources. Russia's the world's biggest energy exporter, and they're willing to sell oil to China in Chinese currency, and that is something no other American adversaries ever had. So I think it's much more. I think there's ideological differences, but I think there's a lot of it is driven by much more nearer-term realpolitik and pragmatic drivers that are designed out of weaknesses, right? Trying to defend weaknesses that China has or that Russia has, rather than starting from a point of we're going to go get the Americans. I think it's more, oh gosh, we need to make sure we prevent this from happening. What's the best way to prevent this from happening? It's to partner with Russia.
There was a pretty amazing interview that Stan Druckenmiller gave on CNBC a couple months back. I don't know if you guys caught this, but he went on and he kind of described why he thought that the U.S. might lose reserve currency status within the next 15 years. And you hear a lot of that kind of stuff on Twitter, but to hear it from Stan Druckenmiller just kind of hits a little bit different. Grant, what are your thoughts generally on the construction of the monetary system today? Obviously, we're seeing unprecedented things happen in terms of easing and money printing globally. Does this seem sustainable to you? Do you think that we're going to have a monetary system with the dollar at the center come 10 or 15 years from now? What are your thoughts about how this whole system is structured?
Well, Michael, I think that the timing is always the tricky thing. These fiat currency systems fail always. That's just the way they reach the end of their natural life, because exactly what's happened with this one happens with all of them. They get abused, and the hegemon and the country with reserve currency has to print a whole bunch of money, has to run deficits. And ultimately, these things topple over under their own weight. We've seen this before with just about every system that happened. People forget that before the US dollar, the British pound was the global reserve currency, and that was kind of struggling and a little bit weak. And then the Suez crisis basically put a fork in it. And America played their hand very, very well, and that was it. That was the end of the game for the British pound. And the thing that people should understand is just how quickly it happens. Once it reaches that terminal phase, and once it takes too much to defend the system than it does to topple it over, the end will happen fairly quickly. The Berlin Wall coming down happened like that. Now, if you look back at it, and you look back through Gorbachev, and you look back at Glasnost and Perestroika, and you can see how it happened. But at the time, the reporting, the coverage of the Berlin Wall coming down was, oh my God, the Berlin Wall's coming down, and communism fell over overnight. When you look back at these things, the speed with which they actually unravel, to the extent that everybody understands what's going on, is faster than you can even comprehend. And the same thing is likely to happen to the dollar. So trying to put a time on this is, it's kind of futile, frankly, until you can see the end in sight, and then it'll happen very fast. But I think the thing that's happened over the last 5-6 years, and nobody's frankly written or talked about this better than Luke. I think Luke's been absolutely all over this, and brilliantly so, I have to say, Luke. It's entertaining these possibilities. It's refusing to just to dispel this idea that the US dollar will lose its reserve currency status. People will just say, oh, well, that's ridiculous, which is such a dangerous attitude to have. It will happen. The question is it a problem you have to think about today? And I think you have to think about it more today than you did yesterday, and you'll have to think about it more tomorrow than you do today, because time is ticking. We're seeing how fragile the world economy is. We're seeing how weaponized everybody is having to become to protect their own domestic affairs. And key to all of this is the dollar. And I think Luke has been all over this idea about the ability of these countries to pay for oil in their own currencies, how crucial that is. And a lot of people don't quite understand what happens if oil can be paid for in euros or can be paid for in yuan. Suddenly there is a need to hold those currencies in reserves for every oil importing country in the world at the expense of the dollar. So this is a hugely important game that's being played, and the US has been on the front foot for a long time. But to assume it will be powerful enough to repel these forces forever, I think is a very, very foolish attitude to take.
Howdy, everyone. This episode is brought to you by Coinbase Prime, the leading prime brokerage solution for all things digital assets, providing secure custody, trading, and financing to an institutional suite of clients. On the retail side of things, I am more than happy to make this endorsement because I have been a customer of Coinbase since the day that I got into crypto. I still keep the vast majority of my assets there, actually, and I do it for one reason and one reason alone, so that I can sleep easy at night knowing that my funds are safe. It's the same reason when family or friends ask me, where should I buy my first Bitcoin? I direct them to Coinbase. And now, finally, when institutions are starting to ask, what's the most safe infrastructure to use? I only point them in one direction, to Coinbase Prime. And the reason that I do that is because it is peace of mind. When it comes to security, Everything is top of the line on this platform, and it's a white glove experience to boot. They've been securing client assets at scale for 8 years, which as of Q2 of this year is $180 billion. They have an industry-leading insurance policy, and they're audited by blue chip auditors so that you can sleep easy at night too. So, stop listening to me, click the link at the bottom of this episode, and go check them out for yourself. And when you get there, tell them that I sent you because I love to get credit. When it comes to crypto, security and custody is paramount. Introducing this episode's sponsor, Ledger, your secure gateway to buy, exchange, and grow your crypto assets. I know I've got a smart audience, so I'm assuming / hoping that most of you already have your Ledger hardware wallet, but just in case you don't, this is how I think about it. I wouldn't get into a car if I couldn't wear a seatbelt, and I don't operate in crypto unless I can do it from my Ledger hardware wallet. Crypto is really exciting, but it is still the Wild West. There are lots of risks, and Ledger is the easiest way to make sure that you are still protected. And the best part about Ledger is that you don't need to make any trade-offs between security of your funds and utility of your assets because Ledger has Ledger Live, which is a software that syncs right up to your Ledger hardware wallet, and you can do anything that you'd want to do with your crypto assets. You can easily send and receive, you can buy and exchange, and you can get access to staking. And they've actually started to aggregate some of the best DeFi apps and services out there. Two of my favorites, Paraswap, a decentralized aggregator, and they've got Lido for staking. And stay tuned, I'm going to keep you guys updated. They've got some really cool services coming out soon. Aave, Compound, and 1inch among them. So if you take one thing away from this, guys, please make sure that you're protected in this space. Get yourself a Ledger hardware wallet today and start using the Ledger Live app. Click the link at the bottom of this episode. Thank me later. Let's start to kind of speculate a little bit, pull at that thread of what could it be? What's the catalyst that might, cause things to unwind? And I was telling you guys before we got on this interview, just because I'm a huge nerd and this is the kind of things I like to do, I've been going back. You can look at Fed minutes going all the way back to like the 1900s, and I was reading green books from the late 1960s, early 1970s, and that was when inflation started to finally pick up. And I got to tell you, it is eerie. It is eerie reading the way that they talked about it back then. Prices are going up, but we expect them to moderate in Q3 of this year. Oh, yes, CPI is up, but, if you excluded this one item, it would be... I mean, it's nuts. I feel like I'm seeing it, and I feel like I'm experiencing it in my life. Like, shit is more expensive for me than it used to be. So... what's your thought, guys? Like, I feel like I'm finally coming around to the idea that I'm just living through inflation, and I just don't think they're going to admit it for a little while.
I think you've got to use sort of a blend of things. I think a lot of what you see in the 60s, or late 60s, early 70s, I think are apropos in a way, right? Because really what blew up the budget was the Vietnam War, right? So we have an element of a war, an ill-advised war blowing up the budget to some large extent here again. So that's similar. But then I also think you need to bring in other time periods to adjust for the reality. So in the 70s, U.S. debt to GDP was 25-30%, right? So something I find is wildly underappreciated still is in the 70s, they could let rates be the release valve. Yes, the rates may have been negative on a real basis. The rates were following inflation. And so the reason gold rose while rates rose in the 70s was because rates were not moving as fast as inflation. Real rates stayed negative the whole time. We're now at 125, 130% debt to GDP. We are in no position to allow rates to be the release valve. There's only one possible release valve, which is the currency, which speaks to your point, Grant, and I think it might kind of tie into a potential trigger is when this thing goes, the trigger might just be the Fed saying, yeah, we're going to inflate. Because now the debt amounts are so big, the derivative amounts are so big. You have to adjust for supply chains, right? So back then, we were still a manufacturing nation. We were making our own stuff. We had manufacturing wages, right? So there was a much greater, I think, ability as an economy to absorb that type of inflation and still sort of retain the ability to function than we do now, where our supply chains are 3,000, 5,000, 7,000 miles away, and we're highly financialized, where we're a finance society and can't afford. What happens when you start having negative real rates go -5, -10, -15, -20%? What is a bank going to make a mortgage loan when they know real rates are running -20? Experience in Latin America would suggest no, they won't. And then what do you do? Does the Fed do it? So it could all feed on itself really fast. And so I think you need to overlay that to the, sort of make that adjustment of the debt levels to the 70s example. I think you need to go back to post World War II, where we were at 110%, and we sent real rates to negative 15% when the Fed capped yields, and I think that's instructive. But here too, the U.S. was the world's only standing superpower, only functioning industrial base, had all the gold, we were the world's biggest oil producer. So we were in a much better position. I think you have to go overseas, and I think so many investors they sort of have the flag at the masthead of the term sheet and say, well, we're America, and hashtag Murica. Yeah, there's nothing like this could ever happen. But when you sort of cross off the flag on the term sheet and you go to something Grant and I talked about earlier this year, Germany's position post World War II, post World War I, when you look at this massive inflation adjusting reparation, which for them were war reparations owed in gold, and for America are entitlements owed in either healthcare goods and services, which are a foreign currency the Fed cannot print and which will rise in price as we print more to pay them, or even Social Security, where I just saw last week that right now the cost of living adjustment for Social Security for 2022 is forecast at 6%, while the 10 years at 1.4. And so you can see at that, so I think you need to overlay that on there. And that's not to say I think we're going to hyperinflate but I do think this inflation could be much more vicious, much more quickly than what we saw in the 70s or in the 40s and 50s for those reasons. So I think you have to kind of we're in unprecedented territory. We've never had the entitlements we've had. We've never had the debt we've had. All these things have sort of never happened in human history. But there are lots of different periods of time where a little bit of each period rhymes, and you kind of gotta sort of strip a little bit off of that and put it, piece from here, and you put it together, and you end up with sort of, something with a lion's head and eagle's wings and a serpent's tail, or some sort of animal that we don't know what it is, but you can kind of get a sense that it's might be unpleasant.
Yeah, I think putting this together, what makes me so uneasy about all this, and maybe I'll tell this to you and you'll make me feel better, or you'll confirm my own fears here. But when you look at transition points in histories, periods of great peace usually have one hegemon, right? That's so large that they're unchallenged, right? And that could be the Pax Romana, the Pax Britannia, the Pax Americana, whatever. Maybe it looks like we're edging towards the end of the Pax Americana, and you have this rising power in the form of China. At the same time that you have that rising power, you're dealing with domestic disturbances, right? And we haven't really talked about wealth inequality, and honestly, the resignation of both of these Fed governors might go down as kind of this, moment in time that people remember, because it really is emblematic for that moral decay, Grant, that you were talking about. And I guess what I worry about is, it seems like all these things are coming to a head at the same time. Is that just me? Am I the only one that feels like that? Am I alone in my sense of kind of existential doom here?
It depends, Michael. Do you want us to make you feel better, or I mean, what do you want?
Grant, I honestly don't know. It really depends on what comes out of your mouth.
I think that creeping sensation you've got is absolutely right. I think again, and this is end of empire stuff, right? This is when the various cracks in the foundations of the empire become too widespread to be able to just plaster up one part of it and hold the thing together. And these things always sound apocalyptic when you talk about them, and people go, "Oh my God, this is doom mongering." But look, the British Empire crumbled and fell, and their time as reserve currency ended. But last I visited, England was there. You can still get a pint of beer in the pub and watch the football on Saturday. So, it's not apocalyptic. It's just a change in the world, and that can be very discomforting for people who are used to a given environment and a given set of actors who they believe they know where to place them all in the range of black hat to white hat, and we know who the good guys are, we know who the bad guys are, and it's very uncomfortable for people to live through those times. Unfortunately, they only happen every 50 odd years, so it's really a kind of every other generation that really has to live through them. This one has been extended by the fact that kind of everybody's been on the same game. But when you talk about tipping points, I think this inflation thing is way more dangerous than people make it out to be. Given what you mentioned, Michael, quite rightly about the wealth inequality. If you look at Look at wage increases, right? They haven't really happened for almost 40 years. There haven't been any meaningful wage increase cycles as the price of everything has gone up. You look at a chart of the CPI, not the change, but the actual CPI, and it's a 45-degree line. It just keeps going higher and higher and higher. The cost of everything keeps going up. And recently I had a conversation with Steph Pombo with Sam Zell, and he said, beautifully simply, he said, inflation is two things, and one of them is a mindset. And that's the problem, because mindsets amongst a panicky populace are not things you can easily get under control. Once that bug gets in people's heads, that's when the shelves get emptied of toilet paper, and that's when you can't buy a generator, and that's when you can't buy beer because it's all been stockpiled. And so when you look at the supply chain issues we're having in the teeth of an inflationary pulse that is lasting longer and going harder than anyone supposedly educated at the Federal Reserve thought it would and assured us it would, when you're assured something time after time and it turns out not to be true, there comes a point in time where you go, you know what? Don't know what they're talking about. And that mindset can switch very quickly. And once it does, we have a very fragile society. We have a lot of people, struggling to keep their heads above water with rising prices. We've had a taste of that with the pandemic last year. We saw just how quickly shelves got emptied and supermarkets didn't have food in them. And another conversation I had a little while ago with Russell Napier, he made the great point talking about the point Luke just made there about capping the yield curve and the fact that it worked after World War II. But the part Russell pointed out that no one ever mentions is that alongside the capped yield curve, they had rationing, they had price controls, and most importantly, perhaps, they had capital controls. So we are very likely to go into a world of capital controls. And again, just like the falling of something like the Berlin Wall, capital controls aren't telegraphed, right? I mean, things will close on a Friday, and capital controls will be in place as of the time Joe Biden makes an announcement from the Oval Office or whatever it may be. So I think people need to understand that as fragile as individual economies are, and as fragile as the global financial system is, it really could be anything that tips this over. The important thing, I think, to understand is whatever tips it, it will happen fast, and you need to at least think through, what do I need to do if I feel like there is an increasing likelihood that some of these outcomes we're talking about happen? Because if you assume they won't, you have no chance. If you assume they will and have your timing wrong, at least you'll know to react faster than all the people that thought it was impossible. But if you think it's possible, you ascribe a likelihood to it, and you make some plans about what to do with your capital and how to kind of best get yourself further up the tree for when people start grabbing at the low-hanging fruit, you at least give yourself a fighting chance. So that's really all it is. Have the courage to think through extreme outcomes, and read everything Luke's written about this stuff, because he's been writing about this stuff for a long time, and he does so in a way that makes it easy to understand and really lays out, I think, just how potentially problematic some of these outcomes are going to be.
I love the way you phrase that, Grant. Allow yourself to believe in extreme possibilities, right? And it does certainly seem like the band of outcomes is being narrowed. So, how do you see this all playing out over the course of the next, couple of years?
Yeah, I agree. I've been doing this 25 years. I've never seen the amount of crosswinds that we're seeing now. And what's fascinating is every aspect where you're reaching an extreme, you're reaching long levels of extremes, right? So we've gone through 80 years of globalization, and that's reversing. And we've gone through 30 years of this U.S.-China relationship, and that's reversing. And we've gone through 40 years of a debt cycle and interest rates, and that's reversing. And you just go on. And each of these are, we've gone through 70 years of a demographic cycle, and that's sort of going upside down in terms of going cash flow negative on entitlements. And so you've got all of these things that are all moving they've all reached extremes, and if any one of them snaps, I think they all kind of start to snap in sort of short order. And I think that's sort of one of two key takeaways. I think it's um, once it happens, once something triggers it, again, I think inflation could very well be the trigger. It's interesting. If we go back to August 2019, former Fed Vice Chair Stan Fischer, former Swiss National Bank Philip Hildebrand, and former Bank of Canada Governor Jean Boivin wrote a white paper for the BlackRock Institute, dealing with the next downturn. And it was basically laying out the game plan for, in the next downturn, here's what we're going to have to do. The central banks are out of ammo on their own. They're going to have to pair with the fiscal authorities, and so the fiscal authorities are going to have to spend, and then the central banks will have to cap rates to make sure there's no offsetting rise in interest rates that hurts the fiscal stimulus. And it's incredible how few people on Wall Street have read this piece. I've been talking about it for a lot. I know Grant's been talking about it as well. But there's something in there that again, former Fed Vice Chair Stan Fischer, just to frame it up for the audience, is one of my best relationships on the street calls him the Godfather. Right? He was Draghi's tutor or mentor. He was Bernanke's mentor. He is the man. Right? And oh, by the way, he also did one of the seminal diagnoses of the Israeli hyperinflation in the early 80s. So he knows, he's lived through this, he's diagnosed how these monetary reforms, as it was called in Israel. And so what they said in this paper is really incredible, is after they lay out, hey, the fiscal need to spend a lot, the central banks need to monetize it and cap rates, is this helicopter money, this is just handing out money to people, and the central bank handing out money to people through the fiscal authorities is all it is. We know will generate inflation. It will absolutely generate inflation. We are sure we can do that. And here we are today, and we see it's absolutely worked. What's incredible is the Godfather, Stan Fischer, goes on to say, the challenge is that there are no instances of history of getting the genie back in the bottle, his words, not mine, or fine-tuning this program for just the right amount of inflation. And I think we're now seeing that, but markets don't get that yet. They've not read this. They don't understand. And then you go back to this context of there is no ability for the Fed to tighten. They can't. And the reason they can't is because if you look at U.S. Treasury spending plus U.S. entitlement pay-goes, it's still over 100% of tax receipts. So the U.S.'s real interest expense is still more than 100% of tax receipts, with tax receipts at all-time highs, with bubbles in every friggin' market. So if they tighten, they're going to decline. They're going to lead tax receipts to decline, and then unless the Fed prints the difference, the U.S. will default on entitlements or treasuries, and that's where we are. And markets don't understand this yet, but I think they're probably within a few months of understanding it. And when they do, the bond market is going to go, oh my God, the only choice the Fed has is to QE more into this accelerating inflation because they have to contain rates. And when you look at sort of the great and I don't want to call it hyperinflation, the great high inflations in history, they've generally all had one thing in common, which is a sovereign that can print money trying to keep interest rates at a politically and economically expedient level. And the nice thing is this thing could be over in 6 months. I mean, you could send inflation to 50, 100% for a couple of quarters, and U.S. debt to GDP will be 70%. The Fed can normalize rates, and it'll be just like that. And people say, "Oh, that's the catastrophe." You go to Argentina 6 months before rates were at 70% in Argentina to match the 70% inflation. Argentinian rates were trading below this similar 10-year rates or treasury rates in the U.S. So I don't think U.S. rates are going to 70, but I think U.S. real rates could go to negative 20, negative 15, negative 20% for a span of several quarters in a row as a means of the U.S. being able to get rid of its debt load and then normalize interest rates after that's happened. So I think these crosswinds, I don't know which of these crosswinds could touch it off. It could be geopolitical, it could be supply chain, it could be military, it could be financial. There's a whole bunch of things all moving around at once. If China, if Evergrande has some sort of contagion, yeah, maybe someone else could sort of go over the cliff first. But at the end of the day, we're all tied to each other around the waist with 6 feet of rope. So if China goes over first, we're going to go over, the Europeans will go over. It doesn't really matter. It's just if anything goes wrong anywhere, everything is stretched so extreme. I think things will develop rather rapidly, like what Grant and was talking and you guys were talking about before.
Let's just, in kind of wrapping up here, let's just talk about how does that translate into markets, right? I mean, even just that phrase, Luke, just having sustained negative real rates of 10 or 20%. I mean, that is extreme financial oppression, right? So I guess where my mind immediately goes is hard assets, right? And you already are, like, just look at the housing market in the U.S. It's pretty unbelievable. I mean, Grant, I know you're also a big fan of gold in general. I mean, how do you think, like, assuming Luke's scenario that he just laid out there is true, how does this translate into kind of markets, and what assets does it sort of make you think about?
I think you're right. I think if it transpires that way, it's the end of the era of financial assets, and it's a return to an era of hard assets. And the fact that, as Luke pointed out, we're seeing this kind of competitive land grab for commodities and resources, that's another tailwind for that trade. And look, valuations are at levels which, even with the inflation we're having now, don't make sense. But as Luke said, the market hasn't really seemed to figure that out. And if you look at some of the inflation swap prices, you'll see that the market is still pricing inflation to be transitory. And look, maybe it is, but with every day it isn't, that mindset Sam Zell talked about gets more and more entrenched. The only place it doesn't seem to be entrenched right now is in Wall Street. And look, Wall Street has a history of believing they're smarter than everybody else. And in many cases they have been, but every now and again, they're just a little bit too smart for their own good. So if you look around and what Luke just described transpires, then there's barely an equity market in the world that isn't overpriced by multiples. There isn't a bond market in the world that isn't in a similar situation. That correlation is going to be incredibly tight on the way down, and that's going to be painful for an awful lot of people. The resource sector is undervalued. What we're seeing, the stresses in the oil market, we're seeing it in the natural gas market. In the UK, we're going back to the 1970s and talking about blackouts and 3-day weeks and all kinds of stuff. And I'm just young enough to not really remember that as a sentient being. But if you think about it in broad terms, if you think about us having had 40 years of a deflationary environment and a tailwind of falling rates, and you look at a chart of rates and you'll see from 1981 to 2021 we've had 40 years of declining rates. It's as perfect a chart as you'll find. If you think about what that's meant for multiples, which have expanded, equity markets which have gone to all-time highs, bond markets, we've got 13 trillion now, down from 17.5 of negative yielding bonds on our hands. If you reverse that environment, if you take away that deflationary tailwind and you turn it to an inflationary headwind, then it stands to reason that all the assets that have performed well over that period are also going to reverse. You are going to see equities doing things that they did between 1968 and 1982, which is to head towards being 5 times earnings with a 5%, 6% dividend yield, which is a world away from where we are now. You're going to see bond markets trying, they can't be allowed to go there, but they are going to be trying to go to double-digit yields. I just finished an interview with Paul Isaac, who was talking about trading Ford motor credits, trading with 30% interest in the 70s. And people think, well, that can't happen today. But the impulse that the market is going to send is absolutely going to be to send those assets to those valuations. Luke's laid out, again, brilliantly exactly why that can't be allowed to happen, and it's up in the air as to what means will be enforced to stop it happening. But the equity market is not so important as the bond market in terms of trying to pick which problems you solve. So I think overvalued equity markets are going to be hugely problematic for people, and I think we're seeing a topping process. If you look at the S&P. And you look what's happening recently, look at the deterioration in breadth, we are seeing something that looks very much like a topping process to me. And I think if your bet is the market hits a series of meaningful new highs from here, I think you're a much braver man than me. So I think the easiest rule of thumb for this is if you believe that deflation turns to inflation, then you need to take the other side of all the things that have worked over the last 40 years. That's a very simple rule of thumb, but I think it'll turn out to be remarkably effective. Equities down, bonds down, commodities up, gold up, big. I suspect Bitcoin, if it can get through the speculative phase of this when everyone's panicking, Bitcoin will do well. The housing market obviously is a tricky one simply because rates are going to want to go higher. So again, real estate isn't priced for higher rates, so that's a much trickier one. But that's the broad brushstrokes to me, and I think it's a fairly simple framework to think about all this in.
Grant, you just mentioned Bitcoin there. One thing that I just don't know how to think about this.
I should never have dangled a hook in the pond, should I?
I'm so, Grant. Okay, Grant. All right, I got to do this now. So I wasn't going to do this until the end, but I listened to this interview that the two of you did a little over a year ago. And again, Preston Pish did this one. It's a great interview. And you're talking about Bitcoin back then, and you were speculating it could go as high as something like 20,000 by the end of the year, but that was like too much to talk about. And Grant, your words back then were, if it really did something more meaningful than that, then I might reconsider my position on it. What's your honest framework for looking at this whole space? Because as we're talking about this doom, I got to be honest. I want to check my emotions. People in the YouTube comments tell me when I'm getting too emotional. But like, I constantly in between this. Like, I think things are kind of falling apart. But I'm so excited about this industry. So where do you come down on it now? I'm just curious.
I spoke to my friend Tony Dean about this earlier this year, and he put it beautifully. He said, "Look, I hope everybody in Bitcoin gets extremely rich. It just isn't for me." He's got other things that he's focused on. There are other things that he understands better. There's other things that he sees fit his risk parameters much better. And it's the same for me. I'm outgunned intellectually on Bitcoin by all these people that spend their lives immersed in it, and I absolutely understand that. For me, I understand the promise of Bitcoin. I think any gold guy understands what Bitcoin offers, right? I think we understand the alternatives it offers to the status quo, and they're hugely important. But I just have too many questions that I can't get answers to make me comfortable enough to decide to commit the kind of time I would feel I had to put into this to understand it to a level where I was on the level playing field with the people who are in it. There are just too many questions for me. So, to echo Tony Dean, I hope everybody makes a fortune out of it. But I suspect if similar price charts of assets hold true here, then a lot of people will lose an awful lot of money. Some people will get very rich. I hope everybody gets out the top. But for me, I just can't get comfortable with having any meaningful allocation to it, to be honest.
Which I and I heard that in the Sam Zell interview that you did as well, and I completely respect that point of view. Grant or Luke, sorry, I guess just closing thoughts here. As a guy who likes gold and Bitcoin together, how do you see those two assets playing out? Let's say that there is some sort of inflationary spiral, negative real rates for a sustained period of time. I guess one thing that I always struggle with is I see Bitcoin as a risk asset, but it also has this narrative and story around being a store of value and a hedge against those things. So how do you weigh your kind of deciding to be in gold versus Bitcoin, and how do you kind of square those two incompatible views?
So I think they are both good ways, or at the sort of the top of the pyramid, I guess, if you will, if you're an upside down Exeter's pyramid, right, which is, at the top of the pyramid. I think they are in terms of ways to hedge significantly negative real interest rates or financial repression. And I think gold has a much higher beta, as we've seen, I think de facto. I think gold, once you understand the means by which policymakers have constrained the rise in gold with the nearly infinite expansion of paper gold derivatives via unallocated promises, futures, etc. And you realize how the structure of Bitcoin prevents in a real way the creation of paper alternatives to pull flows from Bitcoin. That to me, I think, is both gives it greater upside, but also gives it sort of that greater beta. I mean, to me, I think Bitcoin is probably the last true market that we see. I think Bitcoin's also really interesting because I think it will also ultimately force gold to do what it should have been doing all along and pull it alongside with it, if it doesn't do it in its own right. What I mean by that is I think Bitcoin's going to do what it's going to do in response to what I think is a highly likely to be significantly negative real interest rates for all the reasons we talked about before. And as Bitcoin does that, it's going to, I don't know what the price is, what the threshold is in terms of market cap, if you will. But at some point, central banks are going to need to make a decision where either this ecosystem is going to kind of go off and do its own thing and get big enough. And once it gets big enough, then gold, the central bankers are sort of going to be replaced by this autonomous system is going to be the risk, right? This self-governing system. And so it's something I think a lot of the Bitcoin maxis, if you will, as they're called, miss is if the status quo system is ever going to, feels like it wants to defend itself against Bitcoin, they can ban it and they can tax, they can do all these things to it. Some of them might actually work a little bit to slow it down, but I don't think they're going to stop it. If they ever really want to defend the status quo system, they're going to have to let gold go. And when I say let it go, I don't mean 1,700 to 2,000 or to 2,500 or even to 3,000. They're going to need to add a zero to the end of gold or maybe 2 zeros to the end of gold. And they're going to need to wipe out the paper derivative markets or at least rein them in to a significant extent before they do. And what's interesting when I say that is if you look at the Basel III net stable funding ratio moves that already went live in Europe and the US and are supposed to go live in some measure in 4 months in the UK, they look an awful lot like the system, for whatever reason, deciding to rein in the paper gold markets that they have been central bankers' best friends for 35 years. And just now they're deciding to rein these things in as we head towards this seeming highly likely period of significant negative real interest rates and rising inflation and the need to inflate away this debt. So I look at them, to answer the question, as in my own portfolio as, both the two best ways to deal with increasingly negative real interest rates, with Bitcoin having more beta and being sort of this pure read, not having the derivative attached to it, with gold being sort of the lower beta, same direction, but with sort of a call option almost, where if the system ever decides it wants to defend itself, truly defend itself against Bitcoin, they're going to have to let gold go.
All right, guys. I've kept you for long enough. Thank you so much for doing this. I feel like we covered a lot of. I've got way more questions for you, but I'll let you go and not keep you captive for too long. If folks want to find out more about you, Grant and Luke, what's the best way to do that, guys?
Me, it's easy. Just go to grant-williams.com and you can follow me on Twitter at TTMYGH. Nice and simple.
I'm FFTT-LLC.com and at Luke Gromen, LukeGromen on Twitter.
I guess I should have added on the very slim off chance that anyone didn't know who you were before this interview. But guys, this has been so much fun for me. Thank you so much for making the time. And when we have an 8-hour block, maybe we can sit down and actually do this conversation justice sometime in the future.
There you go. Thanks, Michael. You're doing a great job. Really enjoy listening to you. Thanks a lot for having us on.
Yeah, thank you very much for having us on, Michael.